It's not a real ratings downgrade in terms of the ratings from A to B or anything like that. It's more of an outlook to a negative stature, which won't change much in terms of the cost of borrowing or the outlook for investors to invest in the U.S. Treasury market, for example, because it's a very deep market that has a great deal of breadth and depth in it. What it does do is, of course, doesn't help the deficit of the economy, and the country's deficit has been looming large and will continue to do so with an outlook like that, could trigger further deficit financing, and that's really for political reasons. Neither the Democrats or the Republicans like to raise taxes, because to reduce that deficit you obviously have to raise revenue, and that involves taxation, and that's not politically acceptable for their voting constituency. The United States has gone through a business cycle that has been, after the pandemic and COVID-19, went through a major shock where market capitalization dropped from, the stock market dropped from 29,000 plus down to 20,000 and eroded trillions of dollars of market cap. Now that was a shock to the system. Now future shocks could occur, and you have to be prepared to prepare for those exogenous shocks. So I think the U.S. economy, while it's got the depth and the breadth, they have to maintain a profile of maintaining a 2% inflation target, which they're trying to do. So they've kept the interest rates unchanged in the last couple of Fed Reserve meetings. So I don't think the outlook to negative has a serious impact, but the long-term implications is they're going to have to address the deficit, which is going to plague themselves, and that could become inflationary ultimately in any case.